Hello everyone and welcome back. We are looking at a significantly altered market landscape today. After weeks of high-tension volatility, the last 24 hours have delivered a massive shift in global sentiment, catching many off guard. In this video, we are breaking down the critical drivers behind this sudden move. We'll start with the geopolitical breakthrough in the Middle East and the historic double-digit collapse in oil prices. From there, we'll analyze the aggressive relief rally currently sweeping through global equities and the crypto market. We will also dive into the latest central bank developments, including the newly released Fed minutes, to see how the inflation outlook is being repriced in real time. Finally, I'll provide a professional assessment of what this war risk unwind means for your portfolio moving into the next quarter. The most critical development crossing the wires on April 8th is a major geopolitical shift. President Trump has officially announced a temporary ceasefire agreement with Iran, specifically tied to de-escalation around the critical shipping lanes of the Strait of Hormuz. Why is this so important? For weeks, global markets have been aggressively pricing in a worst-case tail risk scenario. Targeted infrastructure strikes, severe supply chain disruptions, and a very real threat of a 1970s-style stagflation episode. Today, that fear premium evaporated. Brent crude absolutely crashed on this ceasefire news, wiping out roughly 14 to 15% in a single trading session. We are talking about a vertical drop from the $110 level straight down to the $93 to $94 per barrel range. WTI mirrored this action, dropping about 15% to sit around $95.90. A correction of this magnitude in one day is extreme. This provides immediate, massive breathing room for energy importing economies and takes a massive weight off the global supply chain. Now, when the threat of a prolonged conflict and skyrocketing inflation suddenly eases, markets generally do one thing: they rotate aggressively back into risk. And that is exactly what we are seeing today. U.S. benchmarks completely reverse their recent war-related losses. The S&P 500 proxy index gapped up about 2.4%, trading all the way up to roughly 6,772. Global indices followed suit, with investors taking cash off the sidelines and rotating heavily into growth, tech, and rate-sensitive sectors, leaving defensive safe havens behind. And speaking of risk, the crypto markets are behaving exactly as you'd expect a highly leveraged risk asset to behave in this environment. With the geopolitical stress temporarily dialed down, the bids are back. Bitcoin surged by 4.5% from the prior day's open, trading near the $71,926 mark. Ethereum outperformed, climbing over 6% to sit near $2,239. When macro fears fade, crypto historically surges, and today was textbook. But how does all of this impact the money supply and interest rates? Let's look at the central banks. Today at 2 p.m. Eastern, we received the FOMC March 18th meeting minutes. Going into today, the Fed has been holding rates steady at 3.50 to 3.75%. The minutes revealed a central bank that was deeply conflicted over whether the war-driven inflation was a temporary spike or a persistent threat that might require more rate hikes. However, with oil tumbling today, that higher-for-longer narrative is shifting fast. We did see a strong U.S. retail sales print today, up 0.6% for February, proving the U.S. consumer remains resilient. But the collapse in energy prices is taking the inflationary heat off. The market is now pricing in 1 to 2 rate cuts for 2026. Still, it is worth noting that the U.S. 10-year yield is remaining sticky at around 4.34%. The bond market is essentially telling us we see the ceasefire, but we aren't celebrating until the actual CPI data proves inflation is dead. Across the pond, the ECB is sitting at a 2.00% deposit rate, and the Bank of England is at 3.75%. Both have been on hold and highly cautious about energy shocks. Today's drop in oil cuts the tail risk for European inflation significantly. Meanwhile, the Bank of Japan remains the outlier. They are hawkish and explicitly eyeing another 25 basis point hike in 2026 if their domestic wage growth holds up. This brings us to our final segment of the video, the professional overall assessment. Make no mistake, today's price action across the board is a classic war risk premium unwind. The market had aggressively priced in a catastrophic disruption to the global energy supply. The announcement of this ceasefire triggered an immediate, violent unwinding of those defensive, inflationary positions. However, as an analytical observer of these macro patterns, I must draw your attention to a critical word in today's geopolitical headlines: temporary. This is a temporary ceasefire. While the 15% haircut in Brent crude gives central banks massive relief and pulls the global economy back from the brink of stagflation, the structural geopolitical friction in the Middle East remains fundamentally unresolved. The equity and crypto rallies we are enjoying today are built entirely on the assumption that this de-escalation holds. If you are an investor, the environment has shifted today from strictly defensive to opportunistic, particularly in the growth and technology sectors that benefit from stabilized energy prices and potential rate cuts down the line. But those sticky US 10-year yields suggest that the smart money in the bond market isn't entirely convinced the inflation fight is over. In the short term, the market is riding a wave of massive relief. But in the medium term, you must keep a very close eye on the upcoming US CPI data and monitor whether the supply of oil through the Strait of Hormuz remains truly unimpeded. Markets are pricing in peace today. Let's see if reality continues to deliver it tomorrow.